you looking for an opportunity to earn a substantial monthly income while helping business owners obtain financing? Then Go Capital's broker referral program is for you. As a registered broker, you'll have access to a variety of business loan and real estate financing programs for clients nationwide. You'll also receive all the training, marketing, and sales support you'll need to quickly start earning commissions. All this at no cost to you. Why is this such a great opportunity? With approximately 30 million active small businesses in the U.S. and banks limiting access to traditional commercial financing, loan brokers offering alternative funding are in very high demand. You can easily earn over $10,000 in monthly commissions by offering loans from $10,000 to $5 million. Go Capital services include revenue-based loans, equipment leasing, business lines of credit, unsecured term loans, commercial real estate mortgages, and more. With us, bad credit, tax issues, and high-risk industries are not a problem. Whether you're an accountant, banker, realtor, no business owners, or simply want to enter the lucrative field of alternative business lending, our broker referral program is designed for you to succeed. Join the Go Capital team and start earning today.
Using insurance policies as collateral. Compliance Officer Training. Introduction. Explanation of using insurance policies as collateral. Using insurance policies as collateral involves pledging a life insurance policy or a property and casualty insurance policy as security for a loan. It allows borrowers to access funds without having to liquidate their insurance policies, and lenders benefit from the reduced risk of default because the collateral is an asset that is easily valued and can be quickly liquidated if necessary. Under the Uniform Commercial Code, UCC, insurance policies can be considered as a type of intangible property that can be used as collateral for loans. Specifically, UCC 9102A, 47, defines general intangibles to include any property, including things in action, other than accounts, chattel paper, commercial tort claims, deposit accounts, documents, goods, instruments, investment property, letter of credit rights, letters of credit, money, and oil, gas, or other minerals before extraction. When using insurance policies as collateral, borrowers must continue to make premium payments to keep the policy in force, and lenders may require borrowers to provide proof of ongoing coverage. In the event of default, the lender may either take ownership of the policy or use the cash value of the policy to repay the loan. Brief overview of UCC 9102A, 47. UCC 9102A, 47, defines insurance policy as a policy of insurance other than a commercial general liability policy or an excess or umbrella liability policy, which is issued by an insurer, including an underwriter at Lloyd's or a reciprocal or interinsurance exchange, to an identified person covering liability arising out of the ownership, maintenance, or use of a motor vehicle or motor vehicles. It is one of the types of collateral that can be used under the Uniform Commercial Code, UCC, for securing a loan or other financial obligation. 2. Types of insurance policies that can be used as collateral. Life insurance policies. Property and casualty insurance policies. Health insurance policies. 3. Requirements for using insurance policies as collateral. Written security agreement. A written security agreement is a contract between the lender and the borrower that sets out the terms and conditions of the loan and the collateral being used to secure the loan. In the case of using insurance policies as collateral, a written security agreement is necessary to establish the rights of the lender to the insurance policy as collateral. The agreement should include details of the insurance policy, including the policy number, the name of the insurer, and the face value of the policy. It should also include details of the loan, including the amount being borrowed, the interest rate, and the repayment terms. The agreement should be signed by both the lender and the borrower to establish a legally binding contract. Identification of insurance policy and insurer. One of the requirements for using insurance policies as collateral is the identification of the insurance policy and the insurer. This involves providing detailed information about the policy, including the policy number, type of policy, coverage amount, and the name and contact information of the insurance company. This information is necessary for properly identifying the collateral and for ensuring that the policy is valid and in good standing. Additionally, the insurer must be notified of the security interest and must agree to the terms of the security agreement. Control of the insurance policy. Control of an insurance policy refers to the ability of the secured party to direct the insurance company to pay out the policy proceeds to satisfy the debt owed to them. To satisfy this requirement, the insurance policy must either name the secured party as the loss payee or contain a collateral assignment clause that effectively transfers the policy rights to the secured party. Additionally, the secured party must notify the insurance company of the assignment and provide evidence of their interest in the policy. This requirement helps to ensure that the secured party has the ability to access the policy proceeds in the event of default by the debtor. 4. Perfection and priority of security interest in insurance policies. Filing a financing statement. In order to perfect and establish priority of a security interest in an insurance policy, a financing statement must be filed in accordance with the rules set forth in the Uniform Commercial Code, UCC, Article 9. Here are the general steps for filing a financing statement. Obtain the correct forms. Typically, a financing statement form can be obtained from the Office of the Secretary of State or similar state agency. It is important to use the correct form for the specific state where the insurance policy is located. Complete the financing statement. The financing statement will require basic information such as the name and address of the debtor, the party providing the insurance policy as collateral, the name and address of the secured party, the party receiving the security interest, and a description of the collateral, in this case, the insurance policy. It is important to be as specific and accurate as possible when describing the collateral. File the financing statement. The completed financing statement must be filed with the appropriate state agency, along with any required fees. The filing creates a public record of the security interest and establishes the priority of the secured party's interest in the collateral. Monitor the financing statement. It is important to monitor the financing statement to ensure that it remains valid and effective. Some states require periodic renewals or amendments to the financing statement, and it may also be necessary to update the filing if the collateral, i.e., the insurance policy, changes or is replaced. Priority rules for competing security interests. Under the UCC, the priority rules for competing security interests are generally determined by the order of perfection. The first security interest to be perfected will generally have priority over later security interests. However, there are some exceptions to this general rule. For example, a purchase money security interest, PMSI, in goods may have priority over a conflicting security interest if the PMSI is perfected within a certain time period and certain other requirements are met. In the case of security interests in insurance policies, the priority rules may be affected by state law. Some states have specific statutes that govern the priority of security interests in insurance policies. It is important to consult the relevant state law to determine the applicable priority rules. V. Default and enforcement of security interest in insurance policies. Advantages: ease of obtaining collateral, low cost, potential tax benefits. When an insurance policy is used as collateral, the creditor or lender may have the right to take possession of the policy if the debtor defaults on the loan or becomes insolvent. The creditor can then collect on the policy if the debtor does not pay back the loan. One advantage of using insurance policies as collateral is that they are relatively easy to obtain compared to other types of collateral, such as real estate or equipment. Insurance policies can often be used as collateral without the need for an appraisal or inspection. Another advantage is that the cost of using insurance policies as collateral is generally lower than the cost of using other types of collateral. For example, there may be no fees associated with transferring ownership of the policy to the creditor or lender. Finally, using insurance policies as collateral may provide potential tax benefits. In some cases, the interest paid on a loan secured by an insurance policy may be tax deductible, which can reduce the cost of borrowing for the debtor. Disadvantages: limited borrowing capacity, risk of policy lapsing or being terminated, potential tax consequences. Limited borrowing capacity: the amount of money that can be borrowed against an insurance policy as collateral is usually limited to a percentage of the policy's cash value. This may not be sufficient for businesses with larger financing needs. Risk of policy lapsing or being terminated: if the borrower fails to make the necessary premium payments, the policy may lapse or be terminated, which could result in the loss of the collateral. Potential tax consequences: depending on the terms of the policy and the tax laws in the jurisdiction, borrowing against an insurance policy could result in negative tax consequences for the borrower. Complexity of enforcement: in the event of default, enforcing a security interest in an insurance policy can be a complex and time-consuming process. This could result in delays and additional costs for the lender. Risk of policy not being assignable: some insurance policies may not be assignable, which means they cannot be used as collateral for loans. 7. Conclusion. Recap of using insurance policies as collateral and UCC 9102A. 47 Using insurance policies as collateral under UCC 9102A. 47 involves creating a security interest in an insurance policy in exchange for a loan or other financial obligation. The policy serves as collateral, providing the lender with a measure of security in the event of default by the borrower. To perfect the security interest in the policy, a financing statement must be filed, providing notice to other potential creditors of the lender's interest in the policy. The advantages of using insurance policies as collateral include ease of obtaining collateral, low cost, and potential tax benefits. However, there are also disadvantages to consider, such as limited borrowing capacity, the risk of the policy lapsing or being terminated, and potential tax consequences. Default and enforcement of the security interest in insurance policies will follow the rules established by the UCC and applicable state law. In the event of default, the lender may have the right to take possession of the policy or the proceeds from the policy. The borrower may also have the option to cure the default or seek relief through the courts.